Hey, everybody. Welcome back to another episode. Today, I've got Mark Khuri with me. Mark's been an avid real estate investor for over 17 years. And throughout his career, he's been involved in sourcing, underwriting, acquiring, raising capital, rehabbing properties, managing, and selling both residential and commercial investments through multiple markets in the United States. He's got a lot of experience. I'm excited to jump into today. He's analyzed literally thousands of investment opportunities. We're going to cover that today as well. Successfully bought, renovated, and sold over 120 properties with a combined value of over $1 billion, and created, managed over 60 real estate partnerships with investors. Super excited to jump in today with you, Mark. Welcome to the show.
Thanks for having me, Brandon.
Dude, it's such a pleasure. I love having guests on who have a diverse background such as yours. We can steer this in a ton of different directions. Before we jump in, for those that don't know you, maybe give us like a little bit of what's your backstory and how did you get to doing this today?
Sure. Yeah. Well, I started out in corporate America, Brandon, like many of us do. I was in finance, budgets and planning, internal auditing, a lot of spreadsheets, and saw my first real estate pro forma spreadsheet at a pretty young age and was pretty hooked. It was a fourplex, I think, that my buddy was showing me at work. And we probably shouldn't have been looking at that at work, but never forget that day. It kind of changed my life. I've been pretty much full-time investing now since 2010. We focus a lot on recession resistance. It's been a big part of our investment thesis and strategy. Really since 2017, 2018, we started seeing some indicators in the market, Brandon. There could be a downturn, there could be a correction, and started really planning for that with our investment strategy. So today we are really a private equity investment management firm. We invest in a few different things. We've tried a lot over the years, and we kind of narrowed it down to just a handful of asset classes and strategies that we think have some of the best risk adjusted returns. I know it's cliche, but we're always trying to find that sweet spot, Brandon, right? With every deal, lowest amount of risk and the highest possible return. And so today we're doing a lot of investing in mobile home parks, self storage, some tax exempt apartment communities, ATMs, and some triple net industrial as well. So that's a bit on us in the background, but very much a real estate investment addict, I would call myself.
Yeah, it sounds like you've been at it for a minute and you've got a really great diversified portfolio. It sounds like, industrial, you said you did some like ATMs as well, self-storage. You said you do some tax credit on affordable housing. We're big fans of the entry level affordable housing niche. You mentioned that like recession resistance is sort of the blanket that describes your portfolio. Like walk us through that. Like what makes these asset classes recession resistance? Like what does that mean to you exactly?
So for us, it means a few things. Start out by saying it's lowly correlated or non-correlated or even potentially inversely correlated to the economy, to the market. So if there is a stock market crash or if there is a economic downturn and the economy goes into a recession, you want to be invested in assets that have a high likelihood of continuing to perform, continuing to maintain positive cash flow, asset valuation, potentially even grow asset valuation. Even if the economy isn't doing so well. So that's a general view of how we look at it, Brandon. We want to be able to not sell at the wrong time. That's usually how you lose money in real estate, and so we want to be able to hold and withstand economic downturns.
So basically, hey, where is money going to continue to pour into despite these economic contractions that, arguably a lot of people think we're in one right now or may have already gone through one. Is that right?
Yeah, absolutely. And the term out there that a lot of people use is recession proof. We don't. We use recession resistant because there's always hurdles. There's always challenges. There is no perfect thing you can do to be immune and proof. But we do find a lot of recession resistant strategies do help us in tough times to stay afloat and continue to persevere.
I know you mentioned that affordable housing is one of your favorite asset classes. Tell us a little bit more about like what makes that recession resistant. Let's get into the nuts and bolts of it.
Yeah, I think maybe it's two-part answer, right? So affordable housing, what is it? A lot of people think, like you and I were just talking, Brandon, Section 8, government subsidized housing. And that's more of a cliche. It's not necessarily how we define it, right? So what
Right.
is affordable housing? To us, it's a little more general. It's housing that can be reasonably afforded by the local population. And that's usually a formula. We're looking at area median income. That is a published figure for every zip code in the country, AMI. And the lower income limit is around 80% of AMI. So folks that are making 80% of the area median income. And then you have a very low income limit, which is 50% of AMI. And so we tend to focus on apartments. We look at mobile home parks. These types of asset classes in certain markets may be one of the most affordable housing options in that area. And one of the gauges that we all typically look at is the rent to income ratio. Brandon, I know you're familiar with it, the 30% rule. You want to have, and this is just a guideline, but rent plus utilities, no more than 30% of a person's gross income.
Mm-hmm.
So if you have an apartment that rents for $1,000 a month, you divide that by 30%, you're looking at, a resident needs to earn about $40,000 a year to afford that apartment.
Mm-hmm.
And if it's a 2-bedroom, then you can have 2 people. And so you can go ahead and divide that by 2 because you've got 2 incomes coming in.
Right.
So that's how we look at affordable housing from more of a definition standpoint. Let me pause and see what questions you have, and I can give examples if that's helpful too.
So what makes this asset class different than, say, normal housing when you get these economic contractions, say like in 2008, 2001, or, maybe even potentially what we're about to experience or what I've already experienced?
Yeah. So on the apartment standpoint, Brandon, I'll give you an example. We're closing today on a property in Houston, Texas. This is a 532 unit apartment community in a very fast growing submarket of Houston.
Mhm.
And the business strategy here is we're partnering with a local municipality. It's a public private partnership where we're able to allocate half of the units at the apartment community for an affordable component that's tied to the area median income. And
Mhm.
so in summary, what does that mean? Rents and income are restricted on half of the units.
Mhm.
The other half of the units are kept at market, so we can renovate them, we can increase rents to market, et cetera. And in exchange for keeping 50% of the units tied to AMI, we get a 99-year property tax exemption. So we don't have to pay property taxes. And so it's a very favorable structure where we're actually increasing the amount of affordable housing in the local community. Of course, there's a business advantage for doing so. And we also get very favorable agency-like financing. On this deal, we have 10 years fixed interest rate, 10 years interest only at around, I think, 78% loan to purchase price.
Mhm. But what makes this perform better during recessions than other real estate
Sure.
assets?
So yeah, great question. It comes back to demand and supply, right, Brandon? You're looking at an asset class that has very high demand, not just these apartments, right? If you talk about mobile home parks or even
Mhm.
just affordable, lower cost single family homes.
Mhm.
Number one, it's extremely hard, if not impossible, in attractive markets to build new and have the rental price or the purchase price, if you're talking about a single family or a mobile home, to be affordable. And
Mhm.
so you have essentially almost a moat around you from a barrier of entry to new supply.
Mhm.
That's especially true in a lot of mobile home park communities. It's very hard to build new and have them actually be affordable. And
Yeah.
during tough times, you've got folks that are stretched, Brandon. They have to cut costs. They're looking to save on housing. That's one of the biggest costs of people's living. And so you see oftentimes an increase in demand for these assets during a downturn, which is
Mhm.
what makes them more unique than some other asset classes. We want to be able to continue to see a lot of people wanting to rent or own these properties.
So supply and demand, when there's less money floating around out there because of these contractions, people look to cut costs. One of their biggest costs is their living arrangements. And when you've got something that has kind of, I guess, like a cap, you work with the city, you've got these tax credits. In exchange for the tax credits, it allows you to lower your rent, which when you lower that, there's a much bigger pool trying to chase that smaller rental income that they want to cut costs. And that's what ultimately creates this demand for this affordable product. I'm curious, and you kind of hinted with this with the tax credits. I guess is are you finding it tough to get these deals to pencil when your rents are kind of capped? I know with multifamily specifically, a big part of the exit strategy in these 3 to 7 year holds is to slowly do some kind of, usually it's a value add strategy, right? Where you're renovating units, you're force appreciating the rents to increase the NOI. You're trying to make it more efficient, and then 3 to 5 years you sell it. How how does this affordability tax credits and kind of capping your rents, how does that help that strategy? Because it seems like it would work against it, but what are like,
Sure.
how does that work? Are you allowed to increase the rents over time, or how does that work with
Yeah.
increasing the NOI?
Yeah. Great question. So think about it this way. Half of the property is
Mhm.
affordable. The other half's at market. So you can do as you please with the market, right? Based on demand and supply of the local market. So the half that's affordable, you can raise the rents, but it's based on the area median income. And so we often look for, and that's published every year, Brandon.
Okay.
And it's basically a framework for the cap on the rents, if you want to call it that. So if area median income goes up, then your rents can go up a little bit as well, because essentially there's more affordability in that local market because people are making more money. If you think about inflation, right? Wages, although not much, they have been going up for the last several years. And so that same concept applies to the rents. You can increase them a little bit as well. But the
Okay.
real advantage from a NOI standpoint, as you asked, is more on the tax savings, right? So if you think about how much tax you pay in Texas for a
Hmm.
lot of these properties, it's got one of the highest millage rates in the country. 2.5% is pretty common. And so you have a significant savings on not having to pay that tax, of course. And that greatly offsets, it can, not always, this is where you have to pay attention, of course. It can greatly offset the reduction in revenue that you might have to implement at the property to have that savings. And so we would pass on a lot of these opportunities, Brandon, where maybe you're stepping on your own foot by keeping the property affordable. You might be losing an NOI or revenue because it's not enough tax savings to offset that cut in revenue. And so
Right.
it's business. You got to operate it like a business. If you're able to increase net operating income by lowering your tax expense,
Yeah.
but you're also lowering your revenue, it has to match up to where it makes financial sense.
Yeah, it's got to make sense. I mean, that's a huge expense if you're able to forego the taxes on that. I mean, that's a very large expense. A lot of people don't account for. So that adds a lot to the cause for the net operating income to increase right there. I am curious, what does the process look like to get these government tax credits? I mean, we're in the entry level housing space. I've met a couple lenders who were like, "Hey, we'll lend to you. We've got a special fund and special terms if the home price is below $365,000. We're actually working on some entitlements ourselves, or kind of around this space, but I've never dove into the tax credits or anything like that. How does that work?
Yeah, so we work with an operating partner. That's the strategy that we've used for all of our investments, where we partner with another investment group that's typically a specialist in one thing. So, for example, in the mobile home park space, Brandon, we work with a few different firms that we have a long track record with that just do mobile home parks and they don't do anything else. And the apartment space, same thing. We've got like the operating partner, we're closing on this asset today in Houston. They are a specialist in affordable housing. They were in the low income housing tax credit LIHTC space for many years, and they have a long track record in this niche in apartments. So what they do is they work directly with the local municipality to get the property tax exempt while in escrow. So it happens typically the seller that is not that the property is not tax exempt when we acquire it usually.
Mm-hmm.
Seller doesn't have that structure in place. And so our operating partners create that in escrow, and then it goes into place once we close and acquire the asset. And the process is it's complicated, Brandon. It's not easy to do. You have to know what
Mm-hmm.
you're doing. To put it in perspective, our operating partners have over 25,000 apartments under management, easily over $1 billion in assets under management. And so you're talking about a very seasoned team. They have a team of lawyers. They've worked directly with the municipality to come up with this structure within the local laws, of course, allowing for this tax exemption, but also making sure that the property is going to provide affordable housing, right? That's the goal. So it's definitely not simple. It's not for first timers, I would say, but
Yeah.
you have a pretty cool process where the end result is really the goal is to create a win-win where we can provide affordable housing and also a nice return on investment.
So is it safe to say for you, you wouldn't consider yourself the expert on obtaining the tax credits. You've done a who, not how, where you have found and partnered with the people who have the team and spent the time and the expertise to figure this out, and you just partner with them.
That's right. Yeah, we diligence a lot of operating partners. Gosh, over the years, Brandon, we've vetted and underwritten probably 130 or more different operating partners across different asset classes. And we have three buckets, yes, maybe, and no, regarding would we invest with them.
Uh-huh.
And the yes bucket's the smallest, and the maybe bucket is kind of the largest, and the no bucket is at least a third of those groups as well. And so that's a process. 13, 14 years now we've been doing that. And we feel as though we've found some really great groups that are really good at one thing. And rather than try and learn all the details, we partner with them and let them do what they do best.
Yeah, I mean, it takes a lot of trust to be able to partner. We're just getting to that point where, we're vertically integrated. We've got our own construction company, acquisition arm, capital raising arm. We go out, we find and manage all of our own deals, but we realize that there's going to be a cap to how much we can do, right? And really it's leveraging other people's time, expertise, and experience to really grow. So I've got to ask this question. I'm very curious. Walk us through, what does your criteria look like, or maybe your filter process for selecting partners? Let's say that you're wanting to go out and add a new branch. Maybe it's let's say you hadn't done the affordable housing thing before, but you want to add that to your portfolio. Like, how would you go about finding those operating partners,
Yeah,
and how would you vet them, and how
sure.
do you know that they're a fit?
Yeah, so this process started for me personally, Brandon, in 2009. When I left corporate America, I had a 401k just sitting idle. Started my own company. You can't invest your 401k into your own deals, just so you
Yeah.
know, it's not allowed. So I opened up a self-directed IRA, but I didn't really know what to do with the capital. And so I went on a 2-year networking binge. I went to a ton of investor meetup groups, networking events, all with really a real estate investment focus. This was all in person. Met a lot of savvy folks, Brandon, through that period of time. Started investing personally as an LP, and some family members as well as LPs into mobile homes, into apartments, into self-storage. We invested, gosh, in probably over a dozen different asset classes in real estate with different operators, and learned a lot along the way. We did that probably for about 7 years, all while being our own operating partner with our investors. We focused a lot on single family and small multifamily. We've bought, sold, renovated, flipped over 60 properties over the years as an operator. But I really wanted diversification for me, myself, and my family. I wanted to spread out my capital, and I could not be a specialist in all these things. And so that vetting process started with meeting and getting a lot of referrals from other investors, from different operators, and then testing them with our own capital and see how they communicate. How do they do? Are they able to answer all your questions in an email, which is a lot of times hard to do if you ever get these investor statements. A lot of times they leave you wondering, what
Yeah.
about this? What about that? And so transparency is a big one. Pedigree is very important. I would say track record is extremely important. Those are some of the hurdles that we look for in an operator. We're usually looking at larger firms that have over 500 million in assets under management. A very, I would say, built out team that's somewhat seasoned, at least a few years of acquisitions team, asset management. We like vertically integrated, but it's not necessarily a line in the sand where they're able to handle construction management and property management in house. So those are some of the hurdles. A lot of the operating partners, Brandon, come from two sources. One, existing relationship that we have with them, or two, they're referred to us from another investor in our group that has had positive experience with them as well. And then it's a lot of talking, asking a lot of questions, a lot of spreadsheets, a lot of analysis. Usually we're chatting with their underwriting team to try and understand how they're thinking about different assumptions in their model. and diving into the financials. And then we do a lot of on-site visits as well to make sure that we understand the team on the ground that's actually communicating directly with the residents and their experience as well to make sure that all are aligned.
Yeah, you guys do a really good job of thoroughly vetting. What are you looking for? Like, what are some of the immediate red flags when you're courting somebody to potentially partner?
I mean, the first one that comes to mind, not enough experience. So especially at this point in the market cycle, Brandon, experience is so valuable. We're
Mhm.
operating partners that have been through multiple downturns before. You just can't put a number to the value of that experience. And so I'd say firms that are 5 years or younger, we're probably just going to wait. We're happy to continue to look at deals and see how they do, but probably not a good fit. And then size of company, growth trajectory is another one, Brandon. If they've been growing really fast for the last few years because capital's been cheap and readily accessible, we'll pause a little bit and look a lot more into the portfolio, how it's
Mhm.
actually doing. Rapid growth is not a bad thing, but it often does result in a little bit more of underperformance in the assets. So we're checking all of that.
Yeah, the faster you grow, if you don't grow organically in the right way, you can always have that little blip. It's going to happen. So faster is not necessarily better in the long run. You harped on something that I want to ask with regards to, especially right now, you're more careful than ever, and that experience bucket is extremely important in your criteria. What steps are you guys taking today with the crazy rise in interest rates that have compressed, net operating income? There's a lot of articles coming out about how, commercial, multifamilies in a lot of trouble because you've got $2 trillion worth of real estate loans they're coming due this year and next year, and with the rise in interest rates, they're not going to be able to get something that is going to be able to cover the debt to service. And it's that everyone's thinking there's just going to be this like wave of foreclosures, especially all the people that got a bunch of bridge debt and didn't get new terms. How are y'all navigating this environment to protect yourselves and your investors?
Yeah, so in early 2022, we've really focused and honed in on fixed interest rate investments or investments that don't have any debt at all. And really where there's in-place cash flow day one, Brandon. So if you buy it and you do nothing, you're already going to get, we look to have 3 to 7% cash flow in year one net to our investors. And that helps protect from some market fluctuations that could happen in the short term. And then we obviously want to be able to grow net operating income. So what's the story behind the asset? How are you going to be able to do that? And how is it correlated to the overall market? Because cap rates have gone up, gosh, anywhere from, it depends on the asset class and the region and the vintage, 100 to 200 basis points, depending on all of those assumptions. And we we built that into a lot of our projections years ago. And a lot of our deals, Brennan, we built in, 100 to 200 basis point cap rate expansion. And so we think that those deals will still be okay and they'll have a decent return as long as we can continue to operate them well. Obviously, if you have floating rate debt, you have a situation where most likely a lot of the cash flow has been eaten up because your interest rate burden has skyrocketed. And then you've also seen, gosh, expenses have gone through the roof: utilities, property insurance, labor, payroll, you name it. I mean, way outside of most people's projections years ago. And so today, you have to almost think about like a stagflation environment where you have, flat revenue and rising expenses. And that is a big problem for net operating income growth, as you can imagine. So, what do you do in that kind of environment? You want to try and find investments that are essentially stagflation resistant as well as recession resistant. So, an example, we just recently invested into a triple net industrial sale leaseback portfolio.
Mm-hmm.
So, we have a portfolio of manufacturing facilities, industrial facilities. They are all 100% occupied. The owner of the business that's using the facility, using the space, a lot of them are getting acquired by a private equity company. Private equity company doesn't really care as much about the real estate. They want to grow the business. And so the business that's utilizing the industrial warehouse, they'll oftentimes sell the real estate and then lease back the space to you. This is a triple net absolute terms. What does that mean? It means once you acquire the property, it's 100% occupied because the tenant was already there, and they are paying all expenses. They're responsible for everything: taxes, insurance, utilities, maintenance. That's all the tenant's responsibility. So your expenses are essentially zero, and they will stay that way through the life of the lease. And your rents, a lot of times we're building in 2 to 4% rent escalation annually. So your rents are going up that much each year. It's already built into the lease. And so you have a situation where if you're thinking about stagflation, as you're talking about, where maybe your revenues are flat or declining in the market, but expenses are going up, cost of debt's going up. If you buy one of these assets and you know how to operate them and you can put fixed rate debt on it, you have a nice situation where your NOI is going to most likely go up annually for the next several years. So that's one of the areas we look at. Yeah.
So you're finding the good deals. I like what you said there about private equity. You're going after man, that must be some. Maybe you've got like the magic Krabby Patty formula for finding businesses that are getting acquired by private equity. But I love that because private equity doesn't care about the real estate. They just want to get that off the books and reduce costs down to where it's just rent. It's just fixed. They're not having any surprise headaches. And that probably gives you an opportunity to pick up these industrial buildings and commercial buildings at a fantastic price because they're not care about that. They just want somebody who can perform. I love that strategy there.
Yeah, it's definitely a niche sector, right, Brandon? And so we work with an operating partner that does this and just about nothing else. And so, again, specialists in one thing, instead of trying to recreate the wheel and learn everything they know, we like what they're doing, so we partner with them.
Yeah, dude, I love it. This has been a pleasure. If people want to learn more about you, Mark, or learn more about SMK Capital Management, where do they need to go?
So our website is smkcap.com. Feel free to take a look around there. You can sign up to join our investor group and learn more about what we do. And then also you can email me at info@smkcap.com.
info@smkcap.com. If you got some questions, shoot on over to Mark. Mark, I appreciate you having the time to come on today and hang out. This has been a lot of fun.
My pleasure, Brandon. Thanks for having me.